Good morning, everyone. Welcome. It is March 8th, Friday, at 6 a.m., half an hour before the market's going to open. My cleaning crew is still here, so I apologize for the noise in the background. Yesterday, we hit another all-time high. Generally, when we hit an all-time high, we pause. So the normal expectation for today would be that we would get a pause, we'd go trade sideways, or we'd pull back a little, potentially to the EMA 8. But we do have the unemployment report that was supposed to come out half an hour ago. So we'll see how that's affecting the market and whether or not that changes the situation. So let's go ahead and take a look at let's look at the report since I'm already here. We have that unemployment situation half an hour ago. We've got non-farm payrolls way higher than expected. The unemployment rate higher than expected. And the average hourly earnings we've got lower, but lower on the month, even on the year. That's really interesting. We've got some conflicting information here, or at least information that doesn't paint the best picture. Non-farm payrolls is up, meaning that we're paying more. Unemployment rate is up, so we're paying more to less people, but the average hourly wage all year on year is still the same. So that means less people are working, but the people who are working more hours. So the average work week didn't really budge that much, though. It went to 34.3. It would just only increase by 0.2 hours. So some of this data isn't really lining up. It's a little weird, but we'll see how the market reacted to all of this. We'll take a quick look at our futures. Our futures are all up, but random. Nothing really standing out here, except for S&P is getting close to non-random. That's not quite a third, but all the rest are pretty far off. Let's take a look on the intraday charts. So this was 5:30 right here. So we had a strong reaction, actually initially negative reaction, but that recovered very quickly, and we've been going up ever since that. So overall, a positive reaction to the reports. You can see how it was much more muted and less volatile before the reports came in. So this movement is entirely attributed to the reports. If we look on the dollar, we'll talk about the dollar in a moment. We want to make sure that's going to be very important to look at. The S&P 500, we came up, we touched the top range of this psychological resistance, and we pulled back a little bit from it, but it looks like today we're going to open above it. If we stay above it, that's going to be very important. That opens the way to continue moving higher, but we'll have to see. And I really should probably get rid of these psychological points now, because now we're just dealing with a normal uptrend. So yesterday we came and we made a new all-time high, but we still closed above the previous all-time high. So normally, again, we would chop sideways or we'd pull back down a little bit. We're so close to that EMA 8, that EMA 8 is a natural level for it to pull back to. And we might come and bounce off of the EMA 8 once again. But right now, there's not as much not so much of a ceiling inside the market. S&P is looking very strong. When we go to QQQ basically went flat with the previous all-time high. This is not as strong as the S&P, so we're seeing a little bit of divergence there between these two indices, and we will want to keep our eye on that. With the Dow Jones, it's even worse. So we definitely want to keep an eye on our major indices, because now we're starting to get divergence. At least so far, on a very short-term basis, the Dow Jones is looking like a downslope. And we only just barely made it to the EMA 8 yesterday. The distance between these two is so small that it should have been pretty easy. So right now, what it's looking like in the Dow Jones is a sideways region like this. And we'll see if we just keep chopping like this, then all of our moving averages are going to converge over here. and that's much weaker than what we're seeing in the S&P. So we're getting a weird divergence, right? The S&P is leading the QQQ, which means that sectors other than tech, other than consumer discretionary, are leading inside the S&P 500, but it's definitely not the big blue chips that are represented by the Dow Jones. So we've got some weird sector stuff going on. So probably the ones that are normally in the middle are the ones that are carrying the S&P 500. So that would be industrials, that would be basic materials. Those are the ones that seem to be carrying this market at the moment. And those are not the ones we normally see lead, especially if it's going to be a strong bull market. So we'll want to see how all of this plays out. All of that gives us kind of uncertainty, but we still play the trends that are here. Is the strongest trend is in the S&P 500, and it hasn't changed for many, many months. So we're going to sound like a broken record. Is keep our portfolios pointed upwards, and at the appropriate times, we're going to hedge. Today, the market seems reasonably strong. We're up in the S&P 500. We're looking like we're going to open near the 516 to 517 level, and that is bullish. That is more bullish than the normal pattern we've seen. It's actually more like over, well, even here, we consolidated for a day. New high, consolidate, new high, consolidate, pull back. A new high, consolidate, new high, consolidate, new high, consolidate, new high, consolidate. So if we make this new high and we don't consolidate, we just go straight up, that is a lot more bullish. So that's more like right here, new high, new high, new high, new high, new high, new high. It starts to look parabolic. So we'll want to see how that develops. If today makes another new high, we're going to watch out for parabolic movement. After a parabolic movement, well, in recent times, it's just been a chop sideways. It hasn't been a full pullback, or a chop sideways, then a pullback. So, but that if it does a chop sideways, then pullback, then we get a range. So it would still be sideways movement, which could still push us beyond this uptrend, and then suddenly we'll be below it, and then we'll have a very different picture. If we look at the DXY, so we haven't looked at it for a while, and I don't know why, because I used to always start with dollar, but I guess it got away from me. So what's been happening is we broke this uptrend that we had. You seen that? And actually, coincidentally, what we were just talking about, the way we broke it was sideways chop. We pulled back to the trend line, and then we chopped sideways. And then over the last few days, we've been moving down quite aggressively. So what happens when the US dollar falls? Well, if any other asset that's priced within US dollars just simply goes flat, then all it means is that it looks like the other assets are going higher. So if my real estate, there's no more demand or no less demand than before for the exact same piece of real estate, but the dollar goes down, it looks like my piece of real estate price went up. But if supply and demand didn't change, the price should be the same. So the dollar dropping down is making other assets look like it's moving up. Gold, Bitcoin, real estate, bonds, the S&P 500, stocks. All of it looks like it's moving up, even if it's really just going sideways. So this applies over the last month or so, especially the last few days. So if we see anything moving aggressively upwards that we can't explain, for example, bonds, it's likely due to just simply this dollar movement. When we look at bonds, bye, thank you. When we look at TLT, we see this 3-day suddenly spike upwards and then upward movement. So the other day I was saying, this isn't really rational. It doesn't really make sense. Well, in the context of the dollar, it starts to make a little bit more sense. The thing that we have to understand about our economy now is that it's very global. For example, the S&P 500, about 40% of all revenue in the S&P 500 is coming in from not from the US, it's coming in from overseas. In China, if you look at their index, or as measured by the FXI ETF, their major index, over 70% of the revenue comes outside of China. When you get transactions outside of the region or the country that the asset originates from, then you have a foreign exchange transaction that happens at the same time. So in the capital markets, we have, or actually I should say in the financial markets. The capital markets is a subset of financial markets. Capital markets are how companies and countries raise money for themselves. That is the bond market and the stock market. On top of that, we have the commodities market. So we have these three major financial markets where money is flowing and exchanging. And then you have the foreign currency market where people are exchanging countries' currencies. You have the foreign currency market has some trading that is speculative, but that is generally the retail trader. They're trying to make money off of movements in the dollars. You don't see the United States saying, I'm going to trade my US dollars for the Japanese yen because I think the yen is going to go up. Then the country doesn't do that. Institutions may do that, but for the most part, movement in currencies is due to all the transactions from the other three financial markets. So you have this kind of Venn diagram. In the center is currencies, and everything else touches currencies, and they all kind of overlap. And that's another reason why you've heard me say that the currencies control the bonds control the equities. So with currencies, or at least the US dollar weakening, and weakening quite rapidly, it's going to look like other assets are going up for a little while. So the S&P, if we see this continuing movement, so the other day I was saying how the way that this could extend is if cash continues to move into the market. Well, there is another way, and that is the US dollar keeps on falling. That's the other way that this could extend. I hadn't been looking at DXY, but now that I've looked at it, the picture is a little bit more clear. So this can continue to move upwards. The good news is that this is a little bit of a hedge. If you have your money inside any asset other than the dollar or savings in the bank, then that asset will serve as a hedge against the drop of value in the US dollar. So this could conceivably continue, and we are going to keep our portfolio pointed upwards and hedge when it's appropriate. For now, you don't really need a hedge. This is, unless you want to hedge against a baby movement to the EMA 8, but that I don't see a point. If you did that, it would just be like a 1 or 2 day hedge. It wouldn't be anything you would want to put a lot of money into. So everything is still looking, that employment report makes it really tricky. Normally we'd say chop sideways. We had a big day yesterday. We're coming off of the testimonials, and there's more certainty in the market than there was a few days ago. So that is one argument for going sideways, one argument for going up. And then we have our 90-day highs, 90-day lows, 10 90-day lows, 473 90-day highs. This looks like the beginning of the week. And at the beginning of the week, what did we get? We got a pullback to the EMA 8, a very sudden pullback to the EMA 8. So this would indicate that there would be imminent pullback, or at least chop sideways. But the chop sideways would have to be a slight downward movement for us to not make all these 90-day highs. There has to be relief from this. This is not sustainable. So we have a mixed bag of signals. it's going to be tough to predict on a 1 day basis what's going to happen. On a 1 week basis, well, I would say that this does have to be relieved. So over a day or three, we could come right back to the EMA 8, which really is not a significant movement. That's kind of normal movement. You can see how often recently we've been touching the EMA 8. It's every few days, right? It's about every week or every few days we'll touch that EMA 8. So it's not a big deal. And it's not a significant pullback. And on that 2 to 3 month basis, we're still anticipating that there is going to be a pullback or correction. And the longer this goes up, the more this market needs it. The sign that that it's more likely that it is actually going to happen is that the QQQ and the DIA are no longer looking the same way as the S&P are. You can see this, or S&P is. You can see that this is not we can't draw a nice straight line for the Dow Jones anymore. We could have maybe over here, but at some point we chopped sideways through this trend line that I just drew. I guess I would have drawn it like this. Okay, so the last 3 days we have chopped sideways through it, and that was what we said was the most likely thing that was going to happen for the S&P, and the Dow Jones just got there first. And you can see that there's no good line that touches a lot of these low points. And what we're getting instead is this kind of curved line. It's curved now. It's not a straight line. So there's divergence. There's disagreement within our major indices. That's a sign of weakness. The S&P, we're just going to have to see when that weakness bleeds over to it, or it remains strong and all the other indices rise back up. But that would be very much against normal market rhythms. We do expect 2 to 3 5% pullbacks and 1 10% pullback in a given year, even if it's just completely bullish. So for us to be halfway into March and not have had any of them, we're kind of squishing. So I guess we're starting to remove the possibility of 3 2% pullbacks, or sorry, 3 5% pullbacks from this year, and say, okay, well, maybe this is one of the years we only get 2, and maybe a 10% pullback or correction. But it's got to happen at some point. We're not going to compress 2 5% pullbacks and a 10% pullback in the last quarter of the year. They have to be spaced out, or at least somewhat spaced out. So we're going almost the entire quarter without any one of those, and it just makes something happening in that second quarter much more likely. So we'll just wait and see. In the meantime, our strategy is follow the trend and hedge when appropriate, and that strategy has been serving us really, really well. But less clear on the picture in the short term, but on a 2 to 3 month basis, we're still very certain that we're going to get at least a 5% pullback sometime in that time frame. All right. But that's going to be it for this morning. We've got a pretty clear picture. I think looks like the effect of that employment report is fading. I actually wouldn't be surprised if that was an excuse or a fake out and we start pulling back and challenging this 512 level, in which case we'd be chopping sideways, which is what we expect after that strong move upwards. So watch 512. If 512 doesn't hold, then we're going to watch this 508, 508 and a half level. And if that doesn't hold, then that's not good news for the S&P. We could keep making a new high, but I don't know. that would mean that this unemployment report carries the entire day, and I just am not sure that is going to happen. Especially, it looked like when we looked on the DXY, yeah, we have a couple news events next week. Inflation rate on Tuesday, retail sales on Thursday. That inflation report, that is going to give us another pause. We're going to wait for that. So could we fly higher today and then pause on Monday and then wait for the inflation report on Tuesday? That's possible. Okay. So, but I wouldn't expect it to just get carried away and fly way up the S&P. Okay. So just watch out for those levels if you're day trading. I would say 512, 508, and then I would say 518, and for sure 520. I'd be surprised if we hit 520, actually, but those are what I'd be looking out for. All right, guys, have a wonderful and profitable session, and I will see you in the aftermarket.